Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar on enhancing audit quality. As we all are aware that today's topic is very important, that is the audit quality. So that is why AASB has taken this initiative to organize this today's webinar. And today is 136th program organized by AASB of ICAI for this council year. Honorable Chairman Sir and Honorable Vice Chairman Sir both are stuck up in another meeting. So I am taking this liberty to start this webinar. And without wasting much more time, I request CA Neha Keshwani ji. Before I invite Neha Keshwani ji, I welcome today's respected speaker, CA Abdul Majid ji, for this webinar. On behalf of AASB of ICAI, I extend my warm welcome to you on this AASB webinar, sir. Welcome to you, Abdul sir.
Thank you. Thank you very much.
He's going to deliberate on audit quality. And we have CA Neha Keshwani ji, moderator of the day. I also welcome Neha ji. I also welcome all the participants of today's webinar. So over to you, Neha madam. Please start the proceedings of the webinar. Over to you, Neha madam, please.
Thank you so much, sir, for this opportunity. It's an honor to be part of Accounting Standards Board at ICAI. As we all know,
Auditing Standards.
Auditing Standards Board at ICAI. As we all know, good audit quality is really important for making sure that financial statements are accurate and trustworthy. And this is very crucial for our investors, stakeholders, and anyone else who is relying on the financials to understand the company's health. So today's session is an opportunity to gain insights from our speaker, Mr. Abdul Majid, who has dedicated over 30 years to the audit profession. As a senior partner at PwC, I will welcome Mr. Majid to bring all the experience which he has on across various industries, manufacturing, automotive, and the list is on. Uh, he also has expertise across multiple accounting and auditing standards amongst US GAAP, IFRS, PCOB, IGAP. We are very fortunate to have you, sir, to guide us through this session. I welcome you to, sir, to start the session.
Thank you. Thank you very much. I'll just put on my slides. I think, first of all, thank you to CA Sanjeev Kumar Singhal, the chairman, and Vishal Doshi, vice chairman. CA Vishal Doshi, vice chairman, for giving me this opportunity. I would like to thank my sincere, heartfelt thanks for the AASB. So I think this is an important topic which I'll deliberate in next one hour 40 minutes, and maybe later on I think we can have the Q&A. Now I think I'll just start off this program in terms of now if you just see, audit quality has been often talked about. I think many people talk about the audit quality. I think especially the last 15-20 years, I think this term has been used. There is no single standard to define audit quality. I think that's a challenge. If you really look at audit quality from the different lengths of the users, you might hear different meaning of it. From our lens, I think we will have one standard. If regulators will look at it something, investors will look at something. So obviously, I think the expectation are differing from each stakeholders. But nevertheless, it's extremely important for us as a practitioner to understand what is audit quality and how we can make it simplified in our mind so that it becomes easy to implement. I think that's something I just want to spend some time on that. So in a normal situation, I think when somebody really refer to audit quality, professional circles or a person who has the knowledge of this profession, the moment you say audit quality, it really comprises of three things overall. One, I think while doing the engagement, how you comply with the accounting standards. Whether those standards are, depend upon, I think, what framework you're following. If you are following US GAAP, you're following IFRS, you're following Ind AS, or you're following IGAP. And sometimes I think you also have the regulatory standards, apart from all the accounting standard, how you comply with those standards. So in nutshell, basically that, the audit or the state of financial statement prepared, they follow the accounting standard in true spirit. I think that's something which we need to just keep back of our mind when we say the quality of audit. This is one of the key criteria. Now, the second criteria is compliance with the auditing standards. Once again, auditing standards, obviously, I think that you have different framework. I think you have, US gas, you have PCOB standards, you have, international auditing standards, then you have Indian auditing standards. So obviously, you need to look at, I think, the auditing standards compliance when you carry out the engagement. I think that's the second one. The third element is the compliance with the applicable non-regulation. I think those laws which impact your financial statement, obviously how you're complying, how the prepared's complied, and how we are trying to audit and get the conclusion that this set of financial statement complies with law and regulations. So I think these are the three broad terms I think we can just keep back of your mind when you talk about audit quality. Currently, there's no standard. Internationally, I think people, the regulators started kind of defining the audit standard definition. I think still it's not out, but there are many drafts available, and you can just see that. But in my mind, I think I just simplify how you comply with all of those things from that perspective. I think that's very, very important as when you talk about audit quality. Once I think we're clear that I think this concept, I think it's a very simple concept, and implementation is always not easy, but at least we know that this is how we can ensure quality of audit. Now, the most important thing, before we jump into the audit, engagements, whether it's a standalone audit or whether it's a group audit, it's very, very important to understand the audit firm infrastructure. If you look at over the last 20, 25 years, lot more importance or a lot more emphasis has been given on the audit firm's infrastructure itself, which you call as a quality management system, or you call it in the various countries you have the definition of how you look at the audit firm's infrastructure. That is something very, very important to understand and see, I think, how the firm implemented this overall architecture of the bedrock, which is nothing but a bedrock for your engagements. So I just touch base on that, in terms of what is more important there, what the standard talks about, and I'll try to simplify. So I think if you look at the standards, I think a lot more importance has been given on the leadership responsibilities within the firm on quality. And many regulators around the world are trying to focus on this area, is what is the culture which has been built in that firm, and what sort of key messages goes to from the leadership when it comes to, I think, the growth, when it comes to audit quality, when it comes to managing the risk, when it comes to addressing the conflicts, which is very, very important, I think, from that perspective. Because end of the day, I think the culture, what you build in, is what is very important. And often, I think, a lot more importance or a lot more emphasis has been given by the regulators on this particular aspect, is what sort of communication the leadership does, how frequently they communicate, monthly, quarterly, and what they communicate. And especially their focus is on audit quality. What are the indicators? What are the parameters? What are the KPIs which the firm has developed to assess the quality in different parameters? So I think that's how they look at whether it's regulatory reviews, internal reviews, or in terms of, I think, the regulatory findings. So many things, I think, in terms of each firm has been kind of, looked at from that perspective. I think here, it's a very difficult to pin down in terms of what sort of KPIs you can build in. But I think just broadly, what's expectation here? The expectation is that the first expectation, as I said, the messages which goes there, from the leadership team, and in that message is what they look at it. One important element is that, basically, emphasis given, and later on I'll talk about a bit more also, in terms of how the quality is being embedded in giving incentive to people. How the incentives have been given, whether, the incentives are just based on the growth or its quality. I think, that's where, a lot more importance is given, especially in the last 10 to 15 years. I think obviously the expectation that you'll have a balanced kind of a scorecard. Growth is important, profit is important, but at the same time, the quality is also important, and how you balance it out, and how you give the messages to your practice, the leadership particularly. For example, they look at in terms of, what sort of, metrics have been developed to assess how much time is spent by the engagement partners, all the quality review partners, and who are the composition of the audit engagement teams, and what sort of, I think, the partners portfolio you have, whether the partner has adequate time to to kind of spend on the engagement, and what sort of expertise is required. So many firms have they've come up with the matrices. So essentially, to just say that whether, in a simple term, adequate quality time by competent people have been spent on that engagement. I think that's the key thing. And also it starts from, in terms of, later on, I think some of the element of leadership I'm going to talk about. So I think that's very, very important from the culture standpoint. That's how you really build a culture of quality within the firm. Now, the second important thing from the infrastructure perspective is the ethical requirement. How do you enforce ethical requirement? what sort of messages you give on ethical requirement, and whether the messages are appropriate, and what sort of actions you demonstrate to ensure that people behave ethically, which is once again important. And many metrics have been developed around different firms, how they assess, basically in terms of looking at the performances and trying to understand in terms of whether the practice at large follows all the ethical requirement and all the policies and procedures put in by the firm, to ensure that I think the ethical requirements have been met. And once again, the ethical culture has been built within the organization, which is extremely important, because I'm just trying to put the outset. Later on, we'll go to the engagement. How do you really enhance the audit quality, through various actions of ours? The third element is independence. This is now once again become extremely critical in terms of how do you assess your independence. And independence laws are not simple, because every country has its own laws. Sometimes the independence laws differs. In India, we have Companies Act as well. Then we have ICAI code and broader things. So how do you ensure that you are already independent? You always are independent. And if you're not independent, what actions you take? I think that has become once again extremely, a kind of a debatable point across in terms of how do you build the independence, and now what sort of non-audit services you provide, how you ensure the independence of it, and are there any conflicts? And as you know, certain services you can't provide, which have been, kind of prohibited by Companies Act, or broadly, I think the standard board globally in India also. For example, I can't audit the books and do the audit of those books, or can't do the internal audit and just do the audit, or I can't really the firm cannot do any ERP, which kind of implement an ERP, which essentially affect the core financials. You can't be an auditor because you're not independent. So how do you really define policies, procedures, how you implement them, and how you take strict action on the independence, and what sort of sanctions you put on people if they don't follow the independence, what sort of culture you are kind of building in, and how you monitor the independence across the organization, what sort of metrics you're building, and how you do the testing of independence. Because if you look at, I think firms also do testing of independence. They go through the independence profile, and then go through all the records of an individual, and they try to determine whether the person is independent. And there are lots of checks and balances now have been put in place. If you were to do any non-audit service for the audit engagement, then I think the necessary approval has to come through the engagement partner and the audit committee. So I think how you really look at this overall independence, what sort of infrastructure you have, what sort of teams you have, how you implement the policies, that is once again very critical to understand that, I think, from the overall culture and the quality perspective. That's is very important. Now, next, acceptance and continuous. See, I think it's very important, from that perspective, to build the quality. When you accept engagement, you got to be clearly aware of the risk, and whether you can mitigate those risks, and it is possible to mitigate, or you don't want to accept the engagement. And here it's a very broad term, because I think when you accept the engagement, you first start with the business model itself. What the company into which business, what sort of business model they have, is it sustainable? What's the regulatory environment around the business model? Whether the regulation is pretty clear. Sometimes what happens now today, the business models are emerging, but law and regulation is not able to keep pace with that. And sometimes you have dilemma, in that business. Okay, it's a new business, but it appears the law is not very clear whether you are tending towards a, bit of a regulatory uncertainty, and whether you need to really accept the engagement, or you shouldn't be accepting engagement. And in some cases, you have an engagement which are highly regulated. The question is that whether you have the ability to meet. For example, you have banks, you have insurance companies, you have mutual funds, all these listed entities. So the regulatory environment is very different from that. So you accept those engagement, whether you have expertise, whether you have the time. Now, next, also, I think if you look at the time perspective, now many a times what happen, you sign the engagement, you sign the book, you sign the financial statement on 9th or 10th of year closure. You got to really assess whether you'll be able to do that. And if not, I think obviously you need to think through whether you should be part of that engagement, or you should, kind of work back on a project to see that whether you complete everything before 31st March. So, and what sort of governance that company has, who are the board of directors, what the organization chart, what's the business model, what are the risks attached to, that particular engagement. And, by doing this acceptance, you fairly come to, certain risk. It'll throw some risk. It could be governance risk. It could be, a regulatory uncertainty risk, whether it could be succession planning risk, or whether it could be business continuity risk itself, right? I think so you assess from that perspective and say, okay, fine, I'll be able to take it up, or I'll not be able to take it up on that. And certain things, even in case of, let's say, group engagement, you and the component auditors, how much you're covering, how much is unaudited, that also is one of the factors. So many things goes in the acceptance. Proper acceptance is extremely important, extremely critical, because often what happens, if you have a governance challenges in any company, it's very difficult to do the audit. So that is first and foremost, you need to understand how it's been governed, and are you comfortable as an auditor, and whether checks and balances are there. And overall, I think, there is a tone at the top, it's been monitored. I think, you have a kind of a risk which are attached is properly addressed. So governance is something which is very critical in this whole thing, apart from business model assessment and other things which I spoke about. Now comes to how and what sort of process the firm has, how they accept the engagement, how they assess the risk relating to engagement. I think that is very important. I think from the process, from policies, procedures, what you put in place, so that you only take the risk which you can mitigate. Because if you take any risk which you can't mitigate, so obviously I think you are exposed, which is once again an important criteria as far as the acceptance is concerned. Now the human resources. This is very important. Now I'll come to, I think, the old standard. You don't have much on technology. I'll come back to it later. Human resources, in terms of how you hire people, how you, I think, started how you make people, how you hire the people, how you train them, how you retain them, how you compensate them. It's not only at the staff level, at the partners level, and how you enforce the accountability framework, which is very important once again, because that's what the regulators are looking at it today. Supposedly, for example, if the engagement is not done very well, it's been, it's regulatory review, the engagement is fake. It's not, it's not delivered what it's supposed to deliver. And how you really enforce the accountability framework of the partners and the managers. Because now that's why regulators are more focused in that area. Because what they're saying is that, which is right, so also, that's how you build the culture. If you are very stringent in that, in terms of implementing, whether it's an independent violation, whether it's an ethical violation, whether it's an engagement, level review violations, or anything for that matter, how you deal with people. And also here, how you look at, sometimes the behavior aspect also comes through, especially the senior leadership team. If the senior leadership team has more number of engagement but less hours, and whether they're, asking for the help, look, I think we'll not be able to do that. So many things goes in this, and how you assign the engagement team. See, today it's very important, because it's very difficult to assign the engagement team, on a general basis. There are certain industries you need the engagement team which is well versed. For example, if you're doing the banks, or you're doing the central banks, or you're doing the non-banking finance companies, or you're doing the insurance, this all requires a different expertise altogether. Or sometimes I think within the industry also, there are many expertise are required, because each industry differs. So how do you really, kind of assign the engagement team? What sort of pool you have in that? And if you don't have the expertise within the organization, how you seek the help from others, which is also important from that standpoint. That's, the what sort of policies are there, what sort of procedures are there. And especially, I think the main focus here is that how do you give incentive to people who hold quality up, up. That's the key now today. So if the quality is, kind of the primary cornerstone, how you compensate people on that. And whether it's not just growth, I think you're not compensating people only for growth, because if you start compensating only for growth, then obviously I think people will take much more risk than what they can deliver, they can really manage. Now, how do you compensate the quality? I think that's what has become extremely important, and how you take the actions if people are not following the standards or policies or procedures what you put in place in that area. So that's what goes on the human resources. And one element is that how you skill people. See, today skilling has become very important. It's very, very difficult, because things are changing so fast. Because of my 30 years experience, I've seen, it's very difficult to keep pace unless until you keep skilling people all the time, both in terms of technical knowledge, and then soft skills, and the technology knowledge, and also the global acumen. Because see, the global acumen I'm talking about, how do you really train people on some of these, at least senior management, members of the engagement, how you train the broader, trend are impacting, the broader ecosystem. It might be impacting the countries, it might be impacting the countries, communities, corporates, because end of the day, I think it's extremely difficult, if you don't do that. And why I say so also is very important to understand. See, when we did all articles and everything, the life is very simple with historical cost accounting. I think it's very easy to do historical cost accounting. There's no judgment. Judgment is there, but not to that extent. But when you move to the fair value, the judgment part is coming very, very important. And particularly, our profession stands on two pillars. One pillar is healthy skepticism. How do you really exercise professional skepticism, which is very important, and it's not going to come overnight. The skepticism comes only through the knowledge what you acquire. That's a pillar number one. And how do you train people in that? Now, a lot more focus has been given by regulators today around the world, that how do you train your resources with professional skepticism, because obviously professional skepticism is very balanced act. You just can't go and doubt somebody's integrity, but at the same time you just can't leave on a face value. You got to do your own work to say that yes, it makes sense to me. It makes sense from that perspective. So how you're training your resources, right from the senior management, the middle management, and the lower audit engagement, on how to exercise professional skepticism. And I spoke about, I think, two or three things in accounting, from my experience, last 30 years experience. One, I talked about move to the fair valuation. Half of your balance sheet is on fair value today. And I think if the fair value is not ascertained through market, it's very, very difficult to audit them. The second pillar, the second one is making sound judgment. Life is not very simple, because you will be making the judgment on a particular day, and after 1 year or 2 years, on hindsight, the regulator might come say, look, you're not looked at it. They'll go back and looked at it, how you exercise the judgment, and what sort of knowledge you had at that point in time, and how you implemented, how you kind of complied with that knowledge what you had, and you made a strong sound judgment. So training in these two skills have become very important from my experience. And because once I spoke about, if you look at it out of the context here today, apart from the fair valuation, your balance sheet size are with intangible assets, brand, goodwill, large investment. These are not very simple to audit, very difficult, unless until you have sound knowledge to make the judgment. I think it's very, very difficult, and you can't do the judgment without really understanding the industry, the nuances of industry, and the problems of industry, or if your clients are in a different market. Let's say, for example, then Africa has its own set of problems. Asia has its own set of problems. Europe, East and West Europe has its own set of problem, and North America and South America they have sets of own problems, because these problems will ultimately impact you. The concept called going concern, it's extremely difficult today to see in 12 months what will happen. And obviously we have been cast upon that sort of responsibility to assess. So that's on the human resources. It's very, very important to kind of hire the talent, train the talent, retain the talent, and some of these aspects which I spoke about. Next comes the engagement performance. So what sort of metrics you use for engagement performance? How do you ensure that in your engagements, how across the board, as a firm, as a portfolio, how do you ensure that the audit plannings are done in much in time? How do you ensure that I think execution is done much in time? How do you do that completion is done much in time? How do you ensure that the paper files and everything, electronic files are archived on a timely basis? So how do you assess the engagement performance? I think every firm has own kind of ways and means to deal with that. Some do through electronic files, some do through manual files, some do through the manual controls. So different firms are trying to ensure that engagement performance, which is nothing but to say that, look, my engagement is complying with the accounting standard, is complying with the auditing standard, it's complying with the applicable laws and regulation which impact financial, because obviously we can't look at all the laws, it's not possible, but at least those laws which impact your financial statement, whether it could be direct tax, indirect tax, it could be labor laws, it could be Companies Act, it could be SEBI requirement, it could be RBI requirement. These are the laws which really impact your financials. So how do you ensure compliance? So that's the performance metrics. So for all these things, I think you need to come up with the matrices so that the leadership teams on a regular basis assess, okay, fine, we are all fine here, or we are not fine here. Independence, we have challenges. We have challenges in acceptance. We have accepted some client, I think we don't understand that industry. And there are certain industries where it's very, very difficult, right? I think, for example, your real estate, your jewelry, some of these, they're not very straight in terms of business practices. So that's on engagement performance, which is very, once again, important. Then the other one is consultation. See, this also is now becoming extremely important from the regulatory environment point of view, because I think it's very difficult, gone are the days where I think the partner can just take a call. or a manager can take a call. What sort of consultation policies you have? And many firms have now come up with the mandatory consultation. They have consultation policy which clearly say that, look, I think we need to have consultation on different areas. For example, you want to have consultation on coverage. You don't have good coverage on consolidation. So you might want to have consultation. Or you have different accounting standard implementation. It's not very easy. For example, there are standards which are not very easy to implement. For example, revenue recognition or financial instrument, consolidations, business combinations, segment reporting, a lot more judgments are required. So you might want to have a consultation to say that in this difficult situation, you need to come and consult. And even auditing consultation is possible. For example, you may say that, look, I don't have a better way of getting audit evidence in this area, I'm struggling. Or quality of audit evidence, I'm struggling here. So you might want to have a consultation. I think more and more in the past, what I've seen from my experience, people used to have a lot more mandatory consultation in law and regulations, mandatory consultation in accounting. Now regulators are pushing that, look, I think you need to have more consultation in auditing. It's not very easy to audit today in terms of, whether it's risk assessment or whether it's evaluating the audit evidences or whether it's in terms of, uh, you know, um, you have evidences which are contrary to each other. So you might have consultation. So I think at least having a bare minimum consultation policy and pushing that to the practice. In these areas, you need to consult. So I think at least you can say that at a base minimum level, we have the quality standard, and difficult areas, we have a process through which consultation. And what happens is that in the whole process, you also change the culture of consultation. Because today, no one can say that they know everything. They need to go back and look at in terms of how to do the consult, how to resolve the issues, from that perspective. Now, the other aspect of is the difference of opinion. So, as a firm, if you have a difference of opinion between the engagement manager and the partner, or a partner and quality review partner, so how do you deal with that? Because see, end of the day, as I said in our profession, judgment is very important, and two people might differ in that. So obviously, I think you need to look at what process you want to put in place to ensure that the difference of opinions have been solved properly. Because the engagement partner cannot sign unless and until you resolve the kind of a conflict and you come to a conclusion. And in some of these cases, I think you might also have to involve expert from outside. It could be lawyers, it could be anyone for that matter, evaluation expert, it could be anyone. So you want to involve just to arrive at and resolve that difference of opinion. So in all of those things, I think the key thing is that how do you develop the policies around this? Keeping back of the mind the culture what you're building, the quality culture what you're building in, and also, and one of the consideration also is very important to understand, which I talked about in acceptance. Are what are the criteria? Are you getting paid rightly? Which is very important once again, right? I think that's more focus has been given by regulators around the world today, that whether you have been compensated as an auditor properly. If not, then obviously, the conclusion what they drive is that I think you're cutting corners somewhere, right? So that's other thing which is when you do the acceptance, which is critical. So difference of opinion, how do you resolve? So these are the things which you just keep, whether you are a mid-sized firm, a small firm, large firm, whatever firm may be, I think how do you really put that basic infrastructure and develop policies and procedures, and you start monitoring them, just not developing and implementing. How do you monitor and where the gaps are coming through? And now, as you know, in some of the countries, these gaps I think are made public, because certain countries around the Western European countries, and even the US and all, I think as a firm you need to just go back and put out a transparency report, which is now becoming flavor. So to say that, look, as a firm, I'm fine, I'm doing everything fine, but having said that, here I have problems, and these are how I'm fixing. So investors or broader community at large, they know that it's fine. I think it's a continuous improvement program. It's not going to stop it anywhere because things are going to change. For example, when you have the quality review from the regulators and you have, let's say, for example, a lot of failure. So that's a problem now. So how you publicly look at in terms of what responses or what actions you are taken to overcome the quality issues what we had. It could be culture, it could be training, it could be infrastructure, it could be whatever it may be. I think how do you identify the root cause? And many firms have now developed a root cause analysis. Whenever they see these issues in these areas, they go back and assess the root cause. Root cause could be I don't give enough training to people, or I don't have enough people to consult, or I don't have consistency in audit, I think I don't have ways and means to do consistency, because many firms use a standard, I think, audit software, which is inbuilt quality standards in that. So you may not have, but you have something else. You may have checklist through which you monitor. So I think whatever it may be, you just need to understand this is very, very important, because this goes long way in terms of ensuring that you will have a base quality. And now I think in India also, I think things are changing. You may even have the transparency report coming through in the future. We don't know, but this is how it's going to be. But end of the day, it adds credibility to our profession, which is good. So obviously it has cost, it has efforts, but we got to do it just to make sure that we are relevant in the long run. So that, so I think I just talked about the infrastructure at a firm level. Now, I don't want to make this as a theoretical, because I want to just look at how I look at audit quality as an engagement partner. With all 30 years experience in different industries, I want to make it very simple. This is how my mind works. I am not, taken from anywhere else. It's just my mind, how I apply on my engagement as an audit partner. I thought that will be more relevant. That's how I implement day in, day out, which I've been doing for the last 30 years in my profession. So I think the first and foremost in audit planning, one thing is extremely important. You've got to get your audit planning right. No, even if you if you spend lesser time in audit planning, you will struggle a lot in the execution phase and completion phase. My experience always has been that spend adequate time to get your audit plan right, and understand that your audit plan you put in place is workable, because you have the client deadlines. Sometimes I think you need to have tough messages to your client. I think if you have some issues you think that will not be able to kind of comply with the client deadlines. Now, once you get into the engagement, first thing you need to really look at is the acceptance. Are there any risks coming from the acceptance? When I'm saying risk, for example, let's say I have problem in terms of some governance challenges in this company. After I accept it, certain things happen, management changes, certain things happen, all of those things happen. There seems to be some governance issues. There are governance issues raised by regulators or public domain. So you want to look at that what it is, because as I said, if you have governance risk, it's very difficult to do the meaningful audit. Or you have complex structure. The structure is so complex, you're not able to really understand. In the acceptance, I think you accepted the client, but later on you come to know that, look, I think it's very complex. So why the structure is so complex? Because the more the complex the structure is, you're going to struggle. And you need to also understand the reason for it, why your structure is so complex, the group structures, whatever it may be. Or you have, significant change in the management. Management keep changing. Then that's also one flag for you. Or the flag could be the sudden regulatory risk. A geopolitical risk is thrown. That could be a risk, once again, to consider, because it might even impact your going concern. So many factors comes into the acceptance where you might see as risk. It might you see as risk of fraud, or risk of material statement through error. For example, if I don't have the trained resources, a lot more churning is happening. Although governance is very good, but a lot more churning is happening. And as a result of that, obviously financial reporting misstatement through error is very high in this client. Or in some cases, the structure is so complex, you're not able to comprehend. So obviously you'll not be able to understand. So you need to be clear on that, to just say that whether the acceptance, what you did when you accepted engagement, when acceptance you are looking at today now, because every year you keep doing the acceptance. And are there any risks coming through? If there is coming through, how you take that input and understand. See, one very important thing we need to also understand, I'm just talking about very practical. There are pressure on businesses today. See, businesses are not very simple today, because you know that certain businesses are going through challenges with climate change. Just look at automotive companies just moving towards the electrical vehicle. And we don't know, I think electrical vehicle is solution or something else also will come through. We don't know that at this point in time. Right? Or there are, obviously oil and gas company. The people talk about sunset for those. Tobacco, sunset. So I think obviously there's a pressure for businesses to move into the different businesses, which are called sunrise businesses. Things like, for example, green energy, or things like, for example, telecommunications. Things like, for example, technology. So because these are all seems to be rising businesses, because all new age businesses. A lot more innovation is happening in that. And you have like startup. I think startup brings their own own risk and challenges, from that standpoint. So you need to understand the pressure point. I always say that, look, I think you need to understand the pressure on the businesses. Once you understand the pressure, you will be able to understand, are there anything which are not comfortable? Many times, I think, I think most of the frauds are happening through, financial siphoning off from one business to other business not able to really fire, then I think the entire thing over. So, you structure which I spoke about. So it's very, very critical for you to understand the business, because today, from my perspective, I think I'll come back to on the point number one. If you don't understand the business, it's extremely difficult to do any audit. It just becomes a paper exercise and we will all expose ourselves. So look at your acceptance and understand the risk and how you're trying to mitigate the risk. And if you're not able to mitigate the risk, you need to make the decision whether you want to continue or whether you want to come out of the audit. And now one thing you need to remember also, expectation. If you want to come out of the audit, then you need to also look at 143.12, because that's expectation, right? I think if you believe that there's a fraud, I think you're not able to go beyond, then you determine that, look, I think here I have the triggers, because the definition of fraud is very, very wide. Then there are reporting obligations, So these all happens at the acceptance stage. Now, next one is the independence. This is at the engagement level. What I spoke about is the firm level, how you monitor. At engagement level, how do you ensure independence? What non-audit services you're kind of serving your client? Are they in compliance with the global standards on Section 144, ICAI code? How do you do that? And if there are any you need to build certain internal mechanism, although you accepted the engagement, which is okay, which is fine, but you want to have some sort of Chinese wall, just to be better prepared, better kind of compliance. See, for example, I'll tell you, let's assume for sake, tax services are permitted. Tax service is permitted, and your firm is doing some tax services. When it comes to your audit, you obviously can't go back to the same team which is advising on tax to client. You want to have independent team. Look, I think I don't want to get to that team. That team is advising the client. I will have my independent team which will assess basically whether it makes sense or not. So I think how do you really kind of build wall around that to ensure that you're complying with independence and you're not really failing in that area, and how you ensure each team member is independent. Once again, what sort of metrics you develop around that. Firms take confirmation on the engagement. At the beginning, they take confirmation. At the end, they take confirmation. Then you ensure independence. But if you have the breach of independence, how do you deal with that? Because there are certain breaches, you don't have to do anything. You just have to make sure that I think you reprimand the person. Certain independence, you have to go back to audit committee. In certain, very rare cases, you need to even come out of the engagement to say that, look, I'm not independent here because of whatever happened, whatever situation is. For example, if you buy an entity, I think the entity you're doing some financial implementation, that entity now becomes part of this entity, and obviously you'll not be independent in that particular entity which has been acquired. So I think it could be many scenarios you need to keep. And independence is just not in the beginning. See, right through the audit, you need to monitor towards the end also, before you sign off. Because I think this where I see the gap. People, they do at the beginning of the audit, and then obviously towards the end of the audit, it just goes off. And obviously you should make sure that non-audit services which you have, which are permitted, you have the approval from the audit committees on the 144. So that is very important from that standpoint. Now comes the risk of, you look at materiality, which I just said, materiality as to how you set that. So this is the first very important judgment you make in your engagement, setting materiality. So here I think a lot of judgments is required, because your materiality decides your coverage. Whether you take on profit, because obviously the benchmark is a profit or loss, you take 5%, depending upon listed, non-listed. But there are certain companies where you say that, look, I think profit may not be ideal parameters, because the investors are not looking at profit, they're looking at revenue. A startup entity, obviously it's not going to focus on profit, rather focus on revenue. So I want to take the revenue. Or for example, you are an NBFC which is just starting its business, you want to just take on the asset base, or you want to take cost plus on expense base. So here I think the senior engagement team, right from the partner, need to get involved to ensure that the materiality are fine. I'll come to group materiality later on, but at least at the engagement level, how do you define the materiality and whether you're comfortable? One important thing I think back of mind you should keep is that by looking at this materiality, what will be my untested population? See, that is very important. If you have untested population, which if you aggregate all, if everything goes wrong and if there's no control map to it, and you'll have material misstatement, then obviously you need to rethink whether your materiality setting is right or you want to take something else. So that untested population, keep back of your mind when you decide materiality, and then aggregation risk and how controls are operating. So these are some of the things which I just want to leave the thought on that. As I said, it's significant judgments are required. Today the focus is there because the coverage is directly linked to a material. High materiality, chances of under-auditing is there. You have, low materiality, chance of over-auditing is there. So you don't want to do either two, you want to do the right audit. You want to get the right audit. So materiality risk is there. I think that's how you really look at it from that perspective. Now comes the risk assessment. So this is once again extremely important to understand the entire process. How do you assess the risk in their engagement? As I said, group, I'll come back later. How do you assess the risk of material misstatement? See, standard talks about revenue. Revenue, it gives a it says that, look, I think you need to consider risk in the revenue. But you can rebut. You can say that, look, I think I don't see it, but you need to have robust documentation. Otherwise, expectation from the regulator is that the revenue, you have risk. Why it is so? Because many frauds, large part of the frauds have happened through the revenue, the top line. So, but you can rebut. You don't have to take all assertion also. You may say in the revenue that, look, I think I have cutoff issues in this. Otherwise, everything is fine. Accuracy is fine, occurrence is fine. I don't want to really focus on those areas, but I want to focus on cutoff. But any assertion which you don't say as a risk, you need to document as to why you don't believe that is a risk. A robust documentation is required. That's one risk. The second mandatory risk which is there, you need to have in your file is the management overall control. You can't rebut that. The standard says that the risk you have to always have in your file, and you need to demonstrate how you have addressed that risk. Management overall risk. Typically, I think you do JV testing, you look at accounting estimate, you look at related party transactions, you look at reconciliations, you see different things you do it to just say that, look, I think risk of material misstatement is not there here in the sense, I think I have, as an auditor, I have mitigated that risk by 4 or 5 areas which I have looked at it. So which could be, I think, general entries, which anyway I'm going to talk about later. You want to see if it's large related party transactions you have in that entity. Look, I think I see related party transactions as one of the risks here. So let me just go back and have my audit procedure in such a way that I understand the related party transaction within the normal course of business, not normal course of business, all of those things. You kind of look at that. You look at general voucher testing, and especially in the banks and all of those things, reconciliation becomes a key. You want to focus on reconciliations. Accounting estimate, I'll once again talk about later. There are certain accounting estimate which are, there's a lot of subjectivity. There's simple estimate, they're complex estimate, right? So obviously, I think how do you, reflect the complex estimate? How do you audit the complex estimate? So there once again, a lot more judgments are required because you don't know the outcome of those estimates. Simple estimate is rent accrual. I know exactly what I'm going to pay. That's fine. But litigation, how much is going to settle? How much is exposure? A lot more judgment. So how do you really understand that? That comes as part of your risk assessment as a management of control. See, apart from these two risks, you might have other risks. You need to think through whether you want to take other risks into consideration. For example, you have large investment, and some of the companies are not doing very well, the investing companies. You might say that, look, investment could be impairment of investment is risky. Or you have large intangible assets. You have brand, you have goodwill, you have all of those things. So you have a lot of these intangibles. So how do you really look at that as a risk? Whether you want to take that as risk, and then how you mitigate that risk. Sometimes you have the large contingency and commitment. Large dispute, exposure, large disputes are happening around, and then you obviously want to look at, I think, how it's been, how it's been, kind of addressed in the financial statement. See, one of the findings from regulators around the world that estimates you guys are not really assessing. Sorry, the risk you're not assessing properly. You're just defaulting on revenue. You're defaulting on management of control, but you're not looking at the other risk. I'm not saying that you should always take the risk, but if you believe that, I think, although it's a major item, but you don't want to have it as a risk, then obviously you will not take as a risk. For example, let's say litigation is an industry-wide issue. It's not very particular to the client. I don't want to take that as a risk. So you might say that. Then you need to document Or related party transaction, you said that it's not a risk because everything is 100% subsidiary. So you say it's 100% subsidiary, and obviously, you know the transaction which is happening. Assume that I think you're looking at subsidiary as well. It becomes easy for you. So you can document. Yes, I think in the normal course of business, we don't see a risk. But if there are transactions with promoters, you want to look at very differently. So I think risk could be, you need to look at each area. You need to understand. Sometimes you have off-balance sheet items, derivatives. A large derivatives. Typically, you see in the bank that is one of the risk actually. So derivatives, how is kind of how the transaction is executed, how it's been fair valued, how it's been accounted, it could become risk. So here, I think my kind of honest submission is that you need to look at the industry, you need to understand the business, you need to understand the financial system line item, then you figure out, I think, how much you believe is a risk, which requires major attention as part of your audit. So getting the risk assessment is very, very important. If you don't get that right, then I think obviously you miss the big areas. Next is basically understanding of business. See, this is very critical today. As I said, businesses are going through tough time, and businesses, they themselves don't know whether what is relevant, what is not relevant. So you need to understand, especially the impact of climate change on businesses, which is out there. So here, I think thing is that you need to understand about customer, supplier, changing customer preferences, the market itself, in which country your client is operating, any particular businesses is coming emanating from that. If you look at today, I think, there's a war in Ukraine and Russia is impacting many businesses in India, Bangladesh even is impacting, or the conflict in the Middle East is impacting many businesses in India. So you need to understand these businesses, then you need to figure out how the risk has been identified and how it's been managed by the company itself. And are you comfortable? Or are there any kind of unmitigated risk you believe? And if so, then how you are trying to address them, right? So product risk also is one of the critical things, because certain products might go out of business. So understanding this business and also understanding the competition landscape. The more competitions, and obviously I think the more innovation, the more pressure, then obviously I think there are chances. And also as a part of understanding business, you can also look at, I'll come back in the fraud risk, how it's been compensated. I think how risk have been, how the growth has been compensated in the overall scheme of, I think, remuneration, which I'll come back later. So understanding the business, so that you understand the nuances and understand, okay, fine, where is the, then looking at the risk analytics. See, this is once again very, very important element. What I normally look at is basically, when you look at profit and loss account, from where revenue is coming through, where the growth is coming from. Is it coming from the existing business or new business? New business in which business, which market? At least to understand. For example, there could be some lot of unusual item. Let's assume that the industry is degrowing, but your client is growing in the same industry. Then you need to understand why. Every other competition is not growing. Let's say automotive, for example. In the country, automotive business is not doing very well, but suddenly your client is showing very healthy results. So once again, the professional skepticism kicks in to understand, okay, fine, whether this is exporting, is going to a different market. So understanding the top line, understanding the margins, understanding the expenses, fixed versus variable, understanding the unusual expenses. For example, many times I see your profits are coming through other income. So obviously it's not sustainable. By selling land and building, if I say profit, it's not going to be sustainable. So the quality of earning is what we call as, are you comfortable? Then the cash flow. See, one particular issue I see particularly today, I think we need to all focus. As I said, historical cost is fine. Today, I've seen businesses which are profitable but negative cash flow. This is one of the indicators for us to look at it. Okay, fine, because it could happen because of your unrealized gain sitting in your P&L account. And as you know, I think the valuation is not a science or arts; it's both. So understanding that also becomes important. Okay, your cash flow is negative, but your profits are positive. And many businesses have gone through, I think they've just become bankrupt in 1 year because of this particular phenomenon. Cash is ultimately king. So understanding the unusual pattern in the P&L account, in the cash flow, and in the balance sheet, whether it's a current assets or whether it's a non-current assets, or whether it's a borrowing, whether it's an inventory, whether it's an AR, whether it's intangible assets, whether investment, so those things are extremely important. And if you're a group company, and obviously you have one more layer of kind of funding your subsidiaries, getting money and funding your subsidiaries. So that's understanding, are there any unusual trend here? And how, if there are unusual trend, and then you want to really focus in that area. For example, I think your client has a much better gross margin compared to peers. You want to really understand what the client is doing much better. because maybe I think he's selling in those markets where the margins are very high. So risk analytics is extremely important because like in hygiene, like a general doctor checks your body, blood and sugar. That's the same thing here for the businesses. So looking at that. Then of course I'll not spend time, minutes of meeting going through and just making sure that I think you understand and are there any minutes of meeting which impact your financial statement, which impact your going concern, impacts your cash flows. You need to look at that once again. Key contracts. See, this is very, very important. Nowadays, I think contract have directly bearing on your financial statement, how you define the contract, the index in place. For example, you may have a contract, an associate might become subsidiary, or a subsidiary might become associate. It's vice versa, right? Or you have contract where you have the um, you know obligation which you need to account for it. Onerous contract, what we call in our term onerous contract. You have onerous contract. I think many times the key thing here to understand your client is how do you really how do you ensure completeness of contract. Many times I think we struggle as a company. What you ensure, how do you accumulate all the contract, which are the standard contract, which are the non-standard contract, and non-standard contract, what sort of implication it have in the financial statement. Understanding that, because many times I've seen big gaps happening around because we don't have, either client have no proper repository, or they don't identify unusual contract. As a result of, we have some big miss in the accounting, because many times in days I think it all goes based on the contract, whether it could be revenue contract, expenses contract, or contract with your subsidiaries, investment, all of those things which are very critical from that point of view, including how it's been, how the key contracts have been, kind of identified. Especially your focus should be unusual contract. And what sort of unusual contract? The definition of unusual contract also you should understand from the client length, because many clients have definition of unusual contract, and most of the bigger client where the contract goes through the legal system. But in some cases, I think they just straightforward contract rent and all, it's all fine. I think that's not a big problem. So understanding that, and obviously factoring that, because you want to factor unusual contract in your testing. So that becomes very important in your planning. Now let's go to the risk, fraud risk assessment. So this is extremely important once again to understand fraud at the financial line item. See, today I think you just can't look at fraud risk at a very in isolation. From my experience, what I learned is that in P&L account, you should start with what can go wrong in the revenue, understatement of revenue, overstatement of revenue, anything possible for that matter, right? So these are risk in revenue, or fictitious revenue could be possible. We don't know. So understand the revenue, because obviously you need to understand this. You need to have proper understanding of the client business model, the governance model, the monitoring model, so you can understand that. Look, I think controls that obviously I think controls are operating and there's no management order of control. You look at, you're comfortable. So you need to look at each FSLI revenue. FSLI is nothing but financials, line item revenue, COGS, where I think you can either underbook, show much better profit, or overbook, show lower profit. That's possible with expenses, the cost of goods sold. Then you also have a rest of the other thing in terms of other expenses, the variable, the fixed variable, variable, semi-variable, fixed expenses. We just need to have better understanding so that anything can go wrong. See, for example, there could be large commission payout. So you want to look at that separately, or large one-off expenses you want to look at separately. So you need to determine with your judgment by understanding the business. Suddenly, I think, for example, you have a new customer, or you have acquired customer which is in the tax haven, or some country where I think the country itself is going through some trouble. So it could be ways and means you can get the information and understand. Similarly, in balance sheet also you need to look at in terms of fixed asset what can go wrong, because many times frauds have happened. People have capitalized expenses which are not capital expenditure, or sometimes people have flushed the capital expenditure to show lower profit. So that's possible. Intangible. See, as you all know, intangible, especially goodwill, unfortunately, earlier at least to amortize goodwill. Now today, I think we test for impairment. And as you all know, I think just by changing two or three assumptions, it could be terminal value, it could be discount rate, it could be risk premium, I can get what value I want. So there's a lot of management bias can happen in that area. So you need to understand, okay, fine, here the risk is very high because a lot more judgments are required. It could be accruals, or it could be contingency, where I think you believe that I think the client has a very poor case. Ultimately, they lose, but they just reflect as a contingent liability. They don't account for it because obviously it might impact their profit. And one thing you need to understand in the fraud risk, how people have been compensated. If people have been compensated based on profit, majority of your compensation is based on variable, you got to take a pulse. See, credit crisis which happened in 2007, right? Not only credit crisis, from my own 30 years experience and looking at whatever I've read about in the past, the frauds have happened because of three things. One, poor risk management policies, because you don't know what risk you're taking. You have a problem in that area. So you don't have proper risk management policies. Secondly, you have poor governance. Third is poor compensation policy. When 2007, all the banks across went bust. They did the study. Ultimately, it boiled down to these three things, that the financial institutions which have failed, they had poor risk management policies, they had poor governance, they had variable compensation policy. That's why I think if you look at today, rightly also, I think, in India, we should hats off. RBI, the bank CEO salary has been approved by RBI. Thanks to the person who rose Companies Act in 1956. Obviously, it's put scale on the remuneration, right? Now, Section 198, which are good inbuilt in India, but it's not there abroad. Now they're getting back to it. So obviously, I think understanding the pressure point, because if you are, and also stock options, the business are in the long term, but today, I think, unfortunately, with fair valuation, with all of those things, we are measuring the business on quarter-to-quarter basis. That is becoming a problem, right? So understanding that, I think compensation policy also very important. So I think here recommendations that look at the P&L account, look at the balance sheet, look at the cash flows, look at the compensation policies, and are you comfortable? And the business model itself. And India, I think, obviously, if you look at many of the startup, unfortunately, are not just going in the way it should go because of poor governance or poor risk management policies. So that's on the fraud risk. I think that you can use a checklist, or you can understand the business, then you can look at, and where the heightened fraud risk. See, the whole exercise that normal fraud risk is fine, because you can't say that there will be no fraud in life. But heightened fraud risk, because of certain events, I think you may say that, look, here, my heightened fraud risk is revenue here. My heightened fraud risk is valuation here. My heightened fraud risk is going concern here. Then obviously you need to do more to overcome that. You can't just leave it there. If you believe that there's negative cash flow, current liability is more than current assets, business is not doing very well, so obviously the heightened going concern risk will go up. So that is the thing which we need to look at from that perspective. Once again, you assess the risk and how you're addressing the risk and how you're concluding, and whether it has any impact on your audit opinion. If it has impact, then you need to bring out very clearly, whether it's a qualification or disclaimer, I think depend upon. Unpredictability. See, unpredictability is one of the area the standard is pushing through you to say that, look, you got to be unpredictable in your testing. Especially the standard requirement is that in the risk area, you need to, for example, you say revenue is a risk area. So you've got to be unpredictable. What's unpredictable? It depends upon your judgment. You may say that, look, I think this company has one particular new customer, I think, to whom they have sold 20% this year. I want to do more testing. I want to understand the transaction, because this customer suddenly come in. He's a related party. Who's that customer? Or suddenly you got one market and you put 20%, 30% growth there. So these are, you might say, okay, low value invoices, I want to check. A lot of low value invoices are there in this company, but I want to understand. It could be various. It depends upon your judgment. What you believe is an event which has happened. You want to really design unpredictable audit procedures and get comfort around that. Sometimes I've seen, I think, if like confirmation what we send, people also send contractual terms as a confirmation, just to understand whether those terms are fine with other party. So you need to be unpredictable and design those procedures and execute those procedures properly from that standpoint. Now comes your accounting estimate. See, any financial statement where there is material uncertainty relating to estimate, you should not really spend time similar on all estimate. You can put estimate into two buckets broadly. Estimate where there is no significant uncertainty. For example, let's say rent accrual, expenses accrual. You know exactly what you're going to pay and you will just provide for it. There's no uncertainty over there. But there are estimate which is significant uncertainty. For example, warranty. I'm providing based on the past trend, I don't know future. Customer preference is changing so much. Warranty could be one, or it could be inventory provision. It could be ECL, including in bank and NBFC. It could be impairment of intangible assets. It could be assessing contingent liability. So anything for that matter, if you believe that, oh, related party transaction itself, there could be some estimates involved or some significant estimates involved. So you need to identify and make sure that where estimates are, the significant uncertainty in the accounting estimate, how you're testing them. Because standard talks about in terms of you understand the process, you understand the past, then you understand the future. Suppose you're sitting in the month of September or June, you're signing it in what things have changed. So you've got to be reasonable in terms of making sure that the assumption looks reasonable from the past and from the present and the future outlook. Because if the assumptions are not really right, then I think obviously that estimate goes very, very significantly, wrong, and the financial statement might have material misstatement. So focus in accounting estimate and your testing approach is very, very important. The more the uncertainty, the more the risk. The more the risk and how you design the audit procedures. See, I have not talked about here CAM. CAM is, obviously I think, you need to have reconciliation between CAM and your, accounting estimate and your risk assessment. So obviously these are two different things. I think, obviously I don't want to spend too much time on that, but I've just given thought that you need to keep back of your mind, I think, when you look at these estimates, risk and the CAM. Now coming back to journal entries. See, journal entries are most important. That how do you ensure completeness? Testing can come later. How do you ensure completeness? That you have the population of our journal entries, because you don't get journal entries in one, like ledger. For example, if you're doing sales, if you do sales audit, you take the entire sales listing, you reconcile with the GL. Okay, tallying, I'm fine. Then I'll pick the sample. But JV is not like that. So first you need to understand how do I ensure completeness. You can do roll forward. You can have system design, roll forward in reconciliation. I'll take opening, I'll take transactions, I'll take closing, and I'll have the JVs. I'll ensure completeness that all JVs have. So once you are comfortable on the completeness of JV, the next important thing comes is that how do you test it? You may say that, look, I think you need to have strategy. There's certain JVs I want to eliminate because I don't say this. Let's say, for example, you have automated JVs in SAP. Those are very automated, very routine in nature. I've tested those JVs, and I do believe that there's no risk here. There's no manual intervention. It all happens through system. And I've tested, I've got comfort. I want to exclude those JVs. Fair enough. But you need to document the rationale, and you need to make sure that the rationale is documented based on your testing and conclusion. So automated journal entries, you want to take it out. Or you may say that certain journal entries, I don't see risk. I want to eliminate them. Fine. Then you have the rationale. You say that, look, I want to focus on certain journal entries passed by CEOs. Obviously, I think no CEO can pass the journal entry, but you have some CEO passing journal entries, bring the high risk, or CEO, journal entries passed by CFO, or generally journal entries passed at a very odd time, midnight 12 o'clock, midnight 1 o'clock, or journal entries passed on the holiday, or journal entries with keywords. For example, you might say that keywords as bribe payment, or I think unusual combination. For example, you want to look at journal entries which is impacting essentially sales and debtors, or purchase and payable, because generally you don't expect cash in that, so you think cash is unusual there. So I think in these areas you need to come up with a JV testing plan. See, all of those things, if you have memos in your file, essentially how you're testing the revenue, how you're testing the journal entries, how you're testing the related party transaction, it becomes very easy for tomorrow if something goes wrong to regulator. Look, at that point in time, I understood the process. This is my thought process. This is how I plan my professional judgment, and this is how I come to the conclusion. So I think you have better chance to defend yourself. And regulators also will take a look at it because your judgment is clearly documented. So I always, as an engagement partner, I always say, look, I think difficult areas, let's make sure we have a robust memo. Whether it could be JV testing, it could be revenue testing, or it could be investment testing, sometimes inventory verification also, because I have invented so many places. Now, how do I ensure, I think, completeness of that, right? That could be an area. So I think the more and more accounting estimate you have, you got to have the memos, you got to be very careful and look at, I think, which are uncertain, where there's significant uncertainty, how you test them. And generally, I spoke about going concern assessment. It's extremely complex area. I think the best thing is that I think one thought there is that whether your business is generating cash or not cash flow. If you don't have the cash flow, you have profit but no cash flow, just be very careful in terms of assessing the going concern, and look at the industry and industry nuances and regulation which is impacting those companies, including geopolitical risk, right? I think whether the company is able to continue. because then the cash is not there, then it's often difficult for the business to continue, especially what we see in the startup and some of the old age economies companies. So this assessment you need to do it very upfront, because today, if you ask me, this is one of the most difficult tasks in my life which I see is the assessment of going concern on some of the engagements. Of course, contingency and commitment you need to understand. See, typically what we do is, pitfall I've seen, people tend to only assess direct tax, indirect tax, something like that. But you do also have the other litigations. It could be customer litigations, it could be contractual litigations, because sometimes I think you have, or it could be off balance sheet item. For example, you have interest rate swap, foreign currency, forward covers you have cross currency swaps. These are all, how do you account for that? How do you value them? How you account for that? Because off balance sheet item, if you don't, show, I think sometimes what happens, they're not in trial balance. The completeness itself becomes a problem, right? How do you ensure that I know all the off balance sheet items we can audit? Today, I think the biggest challenge is that what is not there in the trial balance, I need to identify and go after, looking at. I think that's contingency and commitment, understanding the process and all of those things. One more item which I just, kind of want to talk about is that regulatory environment, how the company ensures compliances. As an auditor, it's not our job, obviously, to check all the compliances, as I said. But first, you need to understand the process. What sort of process the company has? One, to identify all the laws which are impacting, and second, how they comply and how they report non-compliances and assess its impact on its financial statement. See, many large companies or mid-sized companies I've seen, they have compliance tool. To which compliance tool they look at all the compliances, and then they look at in terms of how it's been implemented, and then whether you're comfortable. But as I said, I think your focus will be more on the financials, on those laws which impact financial statement. So that's understanding and how you test, because normally you test in your sales, purchases, and other areas. Some of the laws and regulations like GSTs, TDS, Companies Act, and all of those things. So once you understand all of this, you're in a much better position to prepare the overall audit strategy. I think I'll take next, the next slide I'll go. One particular element is control, because control is very important for you to assess before you come and put a place. Look, I think I want to have the audit strategy, which is control reliance, which is substantive. I think it all depends upon, I think, which area is a high risk area, which is a moderate, which is low, and what sort of testing you do. So broadly, I think that's what should go back of your mind in all these areas. Audit strategy, I just come back in the next slide. I think I'll just go through that. See, understanding the controls is extremely important, and it's very, very complex subject. You need to have this senior engagement team when partners, especially you have the risk and control matrices. So you obviously look at the walkthrough. See, the trouble today is that where the transaction starts, how the recording happens, and how the transaction ends. That is very, very complex today, because many companies have outsourced their accounting. They have the large shared service center. Transaction happens somewhere else, it gets recorded somewhere else, it gets reported. It's not like in good old days. I think you have full visibility to how the client is doing processing. So doing the proper walkthrough, understanding the gap. Where are the loopholes, which might be, people might take the loopholes and commit some frauds. And particularly, I think you need to understand where there could be fraud risk here. Let's say, for example, I'm doing revenue receivable. First question should come to your mind: that how do I know that fictitious revenue will not happen this time? What controls we have that will know fictitious, which is a good to start with, because that's where I think the thinking is required. So you need to look at, as I said in the beginning, I think fraud risk assessment at each financial line item. You can look at in walkthroughs where the gaps are, how the transaction process, where the fraud risk, hidden fraud risk, that becomes easy for you. And then you can understand. And one more very important thing, which I always encourage people to do, is that the moment you look at the controls, bifurcate into three things. One is automated control. So if you have your information general control testing, this is called ITGC, it's all working properly, which obviously I think, you look at a computer operation, computer programming, computer changes, and you're fairly comfortable that, look, ITGC is working properly. Then you can rely on the system report, you can rely on the automated control. But if the ITGC is not working, you have problem in access controls, you have problem in change management, then obviously your IT system, you can't rely. Then you can't rely on those reports. Then you need to do substantive testing. So you can't rely on the automated control. Then you need to figure out automated control, which is a manual control. I can rely. Remember one thing, I think if the organization is very small, it's okay. But if the organization is very big, It's extremely difficult to have the manual control addressing the automated control. The precision you need to look at it, it becomes very difficult. So understanding that automated control, then understanding preventive control. The more the preventive control, the more the automated control, your process, your overall internal control, architecture is fine. But if you're having more of manual control and detective control, it's a problem because you only identify after thing goes wrong. And manual control by nature, it depends on person. If the person is more diligent, he or she does more diligent job. But if they're not, because many times people say that we signed off is fine, it's control operating. No, sign off is not a control operating. It's one of the evidences. Whether the person, if somebody brings bank reconciliation to me, I just sign off, then obviously the control is not good, although I signed off because I'm not looking at it. So those things you need to understand, automated control, preventive control, detective control, ITGC, whether it's there, IT comfort is there. If it's not there, I think how I can rely. And sometimes I think what happens if you have gaps in ITGC and you're not able to figure out the controls, then your IFC could be a problem. Then you'll probably qualify your IFC, right? I think you'll have that problem in terms of qualifications. So I think that's but in some gaps, if you look at in India, at least you can qualify. But in certain countries, if you're IFC failing, you can't give financial statement audit report. That also will get qualified as disclaimer, because those regulators say that if you're not comfortable in control, how the hell you can give, because that's one thing we need to also look at it. If you have a problem in the internal control, can you really go and give clean opinion on the financial statement? Because at the end of the day, you should remember what we are testing is we are just testing only a handful of samples. So then deficiencies, looking at deficiencies, just deficiency, significant deficiency, material weakness. And if it is material weakness, obviously it'll come in your report, significant deficiency will get reported. Then you need to assess the deficiency impact on the financial statement and clearly say that, look, I think financial statement is fine. Because the moment you qualify IFC, you got to keep back of your mind how I'm concluding on the financial statement, because there's a significant judgment you're making. Negative IFC, obviously I think people tend that problem in the financials also. In fact, today regulators are saying that Caro, you have problem, but your opinion is clean. Then you need to have robust documentation as to how you're comfortable. All those deficiencies have been fixed by 31st March, because remember, control opinion you're only issuing on 31st. You're not saying that opinion controls are operating right through the year. You're only saying that on 31st March, these controls are operating because you had some design deficiencies or operating deficiencies the company has gone and put in place. They have addressed those deficiencies. I think then it's fine. So looking at that, results of internal audit testing. See, often internal audit testing might have some red flags. So many times I think you should look at, what sort of red flags the internal audit has identified, whether it impacts the internal control. If it impacts internal control, what sort of impact it has on your opinion and your substantive testing audit procedures. Because at the end of the day, your audit strategy depends upon controls. If your controls are good, your substantive is lower. If your controls are not good, your substantive is higher. So you can look at that, and from that standpoint, and then you can look at in terms of regulatory inspection. Inspections have happened. Obviously, I think what sort of findings are coming through, and many times regulators are saying, especially RBI, saying that, look, we are highlighting so many issues to you guys. You're not looking at it. You're giving clean opinion on that. So you need to look at, I think, in the RBI findings or IRDA findings or any other regulator findings like MCA findings, how it's impacting the internal control, and are you comfortable, and whether the findings are not really impacting significantly or they're impacting significantly, which is not addressed. Even impact of show cause notice and demand notice, just don't say that these are just there. I think you need to understand, do they really impact controls? For example, I have wrongly classified something for GST and I'm paying lower taxes. Tomorrow demand comes. Then your first question is that, okay, fine, demand and all, we can all look at it. Is it really impacting my controls? How did I classify that? Why did I classify wrongly? Is it just because it's a judgmental area, or is it because some clerical mistake happened? I don't know what it is. So just don't ignore that. I think that's in the internal control, because the audit strategy to a large extent depend upon how you assess and test the internal control and conclude on that. The next one, I think the planning I did not talk about, because very obviously I think the confirmations that anyway you do, inventory count you do, because these are two audit procedures. I never wanted to highlight that, but just keep back of your mind. These are the procedures which have been required by the standard to do it, inventory verification or confirmations. That's the other thing which is very important to keep back of your mind, how you do the confirmation, how you get the confirmation, because many times I think the frauds have happened to confirmations as well. So I think you understood this, I think, on internal control from that perspective. I think then let's look at the control environment assessment. So this is also extremely important, the COSO, what you call about. I'm not going to spend too much time on that. you got to be comfortable in the control environment. The board of directors, the composition of the board of directors, the organization chart, code of conduct, how they deal with whistleblower, how they enforce their policies. All of those things will come as part of your control environment. Risk assessment, how I think the business is assessing risk, because many companies have risk register, many companies have risk presentation, many companies have ERM. They look at these are the top 10 risks I have in this company, and this is how we are mitigating this company risk. Some of this risk we are transferring. For example, you are taking insurance, so you need to have better understanding whether you are able to connect. Because suppose, for example, you believe some is risk, I think your client doesn't believe risk, then you need to really understand why is it so. Information and communication, how they enforce the code of conduct, what sort of data they look at it, and how they get comfort on the numbers. These all comes as part of your information communications. Control activities, which is nothing but your all RCM. Because see, remember, IFC opinion, we do it, but board of directors and the companies that have to have their own ways and mechanism to ensure that I think they are comfortable. They can't rely on our report. They need to do their own act. So obviously, I think that happens through control activities. Many companies, either they have outsourced that activity for testing to someone else, or it's been done by the internal auditors. So that's how it happens. I think you need to be comfortable on that. I think whether there the critical thing is that the competence, objectivity of the people who are testing the control. Because, for example, self-control testing is not obviously is good, because if I'm doing my work and testing myself, it's not good. But if I'm doing my work and somebody is going to test my work, I think you will have much more objectivity in that testing. So you need to look at it as part of the control activities. And what the standard talks about is that all key risks, you need to test controls each year. But where there's no key risk and controls you want to rotate, it does allow, I think, the rotation. You can rotate once in 2 years, you want to test once in 3 years, not beyond 3 years. I think that's once again standard gives a leeway from that perspective. Monitoring of control, I think typically it happens through internal audit, or sometimes I think the companies hire forensic auditor do some certain activities, then you need to look at it. So I think control environment is also one of the important piece to keep back of your mind. So I think I'll just quickly go through the group audits. This has become once again a very tricky area because companies have become very complex. First, you need to understand the group structure as a component, as a group auditor. Then you look at the regulatory environment in which the components are operating. See, for example, I may have a client to say that, look, I'm in manufacturing, but nevertheless, I have a subsidiary which is a complex NBFC, or I have a subsidiary which deals in insurance. I have subsidiary in country which is highly regulated. So you need to understand the regulatory environment of the group, not only in your country, the companies, and abroad also. I think, then you understand basically, I think, are there any risk emanating from that? Because highly regulated subsidiary might bring a different kind of risk. Group materiality, the way you set materiality for individual component, individual entity, standalone audit, how do you set up the group materiality? Because once again, here you want to be efficient and effective. You can't have lower materiality or you can't have higher materiality. And there are ways and means in terms of checking that. One, I think the best thing is that you need to keep back of your mind your coverage. End of the day, I think you are consolidated, either you or a component auditors. Together, I think you have to ensure that I think you have adequate coverage. Communication with your component auditors. Then risk assessment of respective component. Do you see any heightened risk in any of the components? Parent company oversight, which is also very, very critical, because if parent company oversight is not there, then it's a problem. Parent ability to fund the group, assess group companies. Otherwise, it will impact the going concern assessment. And also, you need to understand the different gaps and gas. You might have a subsidiary which follows US GAAP, IFRS. Then how do you convert those? Who's auditing the conversion? And whether you're comfortable. Because at the end of the day, I think the biggest challenge in the group audit is that some components are not in your country but different country. The laws are very different. So obviously you need to depend upon the component auditors to understand the laws, whether they impact any financial statement. So all of those things, I think these are some of the considerations you should keep back of your mind when it comes to group audit. Now execution. Let's quickly look at execution. Types of testing. So you could see standard allows you to do statistical sampling, non-statistical sampling. You can do target testing. You can do accept reject testing. Various types of testings have been given by the standard. You need to look at which type of testing is appropriate. Suppose you are testing attributes, you can use accept reject. Or you follow a statistical model, you can follow statistical model, because many firms don't do that. If you're following non-statistical model, so you want to target certain population. So you want to test separately, and remaining you want to just put to the audit sampling. So that testing type is very important, because there's judgment involved there. You can't have, accept reject for, areas where you are testing something else, not attributes. So that you need to look at. And assertion. See, in execution, you need to be extremely careful as audit team or engagement team, what assertion I'm trying to address here. Every assertion may not be equal. For example, if you are looking at asset, valuation is always a problem there. Whether the asset value is rightly reflected in the balance sheet or not. Liabilities, completeness. So, fixed asset existence. So obviously, I think physical verification. Inventory existence, physical verification. So you have assertion, you know. So assertion, you need to look at existence or completeness or accuracy. Whichever assertions you have, whether how you are trying to address the assertion through testing. What steps you're following to get to the assertion. If you want to get to the, the existence, then I'll do the physical verification, right? Or so those you need to be very careful in each line item, whether it's sales, purchases, expenses, assets, liabilities. And then if the risk area is there, adequacy of work. If I've defined this area as a risk, let's assume that in revenue I have cut off as a risk. Then you need to do more work. The expectation is that the more the risk, I think the expectation is that the more risk you do and the more work you do in terms of controls and in terms of substantive. That's one thing. Audit evidences. See, this is once again an area which is concerned because today you have various means of audit evidences. When I did articles, or maybe I think most of you who were in the practice for the last several years, it was very easy. I'll get a paper, I'll look at everything. Today you have different form of evidences. Paper evidences, soft copy evidences. Sometimes I think it's very difficult to make out, I think, whether the evidence is fine. So right evidence also is a judgment. Many times we have indicator of fraud, but we just miss it because we are not looked at audit evidences very carefully. Then quality of audit evidences. Are you comfortable? I'll tell you a simple example. If all the audit evidence are internally generated, then you have problem. Because you need to have some, I'm doing sales. So obviously I'll have sales customer order, which is a third party. Then I will have my own invoice. Then I'll dispatch it. I'll have, receipt from the transporters, third party. So you need to look at mix, evidences, how much is internally generated versus externally generated. Everything is internally generated, pause. Is it right? I think what's happening here, because I need to have the external evidences also, because the more the external evidences, the more quality, right? I think you will get more comfortable on that. That's why you have things like confirmation of. So look at audit evidences and quality of audit evidences and how you're concluding. Because if you're testing, if you have exception, then obviously you can't conclude everything is fine. You need to extrapolate and you need to, the standard gives a different option for you to whether you want to tell the management to set all the things right and then you want to pick up the samples. So execution, these are the nuances. And one more important thing in the execution is basically how you're picking the sample. You need to ensure that the population is complete. See, many times which has happened in the past, I've seen many areas, where a good population is given to you. I think the bad population, the client has kept it. So I think you have, and you have just gone back and picked up the good samples from the good population list and there are no frauds. And he has kept with himself or herself the bad samples. So if you don't do the trial balance reconciliation, you will are in trouble. The first thing you need to do is that, okay, fine, before I pick the sample, I want to ensure that the balance are agreeing with the trial balance. Then I'll pick up the sample. And when I pick up the sample, you tend to pick up the sample right through the year. Because obviously, I think picking the sample only in March or April, March or February, January, you may have a problem because in other months, how you're comfortable. So certain amount of things are also required, I think, from that perspective. And of course, your conclusion and how you do that, I think that's more simple from that. But as I said, I think the execution in the judgment area, you got to be very careful. Where there's significant uncertainty, how you're auditing the judgment, and how you're getting comfortable. One point I did not talk about in the planning, I think, which is also once again given the standard, is involvement of expert. See, today it's gone are the days where an auditor can do everything. When I look at this balance sheet today, sometimes I feel looking how much I'm knowing, how much you have the, you're the actuary, you're the valuation expert, you're the forensic expert, you're the tax expert. So many experts you're relying today. So obviously, I think that's other area I think which you need to keep back of mind. Whether, see, so for example, I've seen sometime inventory you can't verify. You're not expert to verify the inventory. You got to lean on the expert. For example, in glass industry, oil and gas industry, chemical industry, it's very difficult for us to just go back because if just counting laptop or phone, I can just count, I can be comfortable. But certain inventories you can't do that, right? So you need to involve the expert. So I think then once again, the competence, objective to the expert, whether you're comfortable. So all of those things will come through as part of your execution, and you need to be comfortable and how you are, reaching the conclusion on that. Now, let's look at the next, I think quickly in next 12, 10, 10 minutes, audit completion itself. The key thing is audit deliverables, because end of the day, I think that's the deliverables of your, I think the most important thing in the audit is your deliverables, your audit opinion. Opinion on the financial statement, standalone financial statement, quarterly financial statement, quarterly reviews, internal control. Obviously that audit, opinion plays a significant role because that's a piece of paper for you, right? I think to the investor. So, whether audit report is fine, you're okay, or where you're not okay, the qualified opinion, disclaimer opinion, and if you have, as I said, IFC opinion is qualified, why financial statement opinion is fine, how you have bridged the gap, and how you're comfortable on the numbers. So all those things will come through in your audit report. And as you know, in Caro, we have so many stringent requirements. How do you identify them, audit them, how you document? Is it because the Caro this is only increasing. So obviously, Caro is so critical because sometimes the Caro itself gives me a sleepless night in terms of how you are doing each of these elements in Caro, and audit opinion, and IFC opinion. That's a critical thing, and how you communicate those charged to the governance, which is very important. How you communicate to the audit committee, the board, in terms of your scope, your independence, fraud risk assessment, accounting estimates, any accounting issues, key accounting issues, all of those things will come through in that. So that's part of that. You need to spend more and more time. If you have consolidation, obviously, I think consolidation delivers consol opinion, IFC opinion, consol financial statement opinion, and those are the things which I think you need to be weak, and whether they're in compliance with the standard. And I think many people have now taken help of AI. I think in that, I think you have the standard. Good thing I think ICAI has also brought in, which is I'm so happy that they're also bringing AI to kind of look at your audit report vis-a-vis the template what ICAI has, and it throws all the exception, which is very good, I think, from that perspective. Same thing with financial statement. So especially financial statement, I think while balance sheet, P&L, cash flow, a lot of focus is there. Where I see problems is disclosure. A lot more disclosures are required today, right? There are disclosure standard itself. For example, if you look at earning per share, segment reporting, related party transactions, cash flow. In financial instrument, you have many disclosures on softer side of it, especially. So how the disclosures have been identified, because once again I said, the biggest challenge in the disclosure is that they don't come through your trial balance. Certain disclosures might come through trial balance, certain disclosures might not come through trial balance. So first you need to understand where the disclosures are coming from. Are you comfortable on the source? Then you're auditing those disclosures and be comfortable. And if there are any gaps, because once again your disclosures play an important role, you need to reconcile the disclosure, whatever the client has done with the board of directors report. That's why I think the response is cast now today. You can't have not consistent information in the notes to accounts and or financial statement or the board of directors report. So that you need to look at from that perspective and the presentation disclosures. That you can do through checklist. I think you can have all completion checklists, many checklists you have, companies like checklist, Caro checklist, India's checklist, auditing standard checklist. You can use of those checklists to ensure that is, or NBFC checklist or bank checklist, insurance checklist. Many are available just to ensure that you fill those checklists and try to identify that you're fine in terms of the audit work done and deliverables. And then some, if you have the, there are certain things, the entry has not been posted. Now you need to look at impact of that, summary of unadjusted errors, what we or matters, what you call as its impact on the financial statement, impact on IFC. Generally, I think if you're all whatever error you identified, they're below your performance materiality, you tend to take it to some, and you also include that in the rep letter. And then you also need to take the rep letter from your client. In the beginning, I think you have the engagement letter as part of that, and here the rep letter. You got to just take that in from your client. That's part of your completion activity, and just making sure that I think other reporting responsibilities essentially includes how you're archiving the file, because now I think you obviously once you sign up you can't touch the work paper. How you archive the file, how you kind of make sure that there is a robust mechanism of not touching the file once you sign off. So some of these things will become kind of as part of the completion activities from that standpoint. So I think if you can look at some of these things, and obviously if there are any gaps, you will identify, you will address them. So overall, I think this is how you should look at from the perspective of your audit. One, I think, looking at the planning phase very critically, getting your audit strategy right in the first place, assessing risk properly, determining materiality properly, both group materiality and your materiality, which is a critical thing from the planning perspective. Execution, how you execute through different methods, which I spoke about, which is very, very important, and how you deal with the exception, which is important once again from that standpoint. Then the group audits, to summarize, I talked about, how you do that. One particular thing in group audit is that, whether the books have been closed on the same year, because many times I have challenges in terms of, you are doing it 31st March, but subsidiary is only closing the books in December. The 3 months gap is there. So how do you deal with that? It's a complex matter once again, from that standpoint. So if you have any, because many companies have their subsidiaries in European countries where they close the books for December. Sometimes they audit for March, sometimes they don't audit for March. So, once again, and other thing is very important that in consolidation, if you are relying, so obviously, I think, a lot of unaudited information goes sometime, right? You say that you have covered something, component audit has covered something, but something is unaudited. Unaudited, I think you got to be careful. What is the size of it? Whether are you comfortable? Because I've seen cases where I think, the group audit has covered 30% and component has covered 40, 70%. But 30% is, now at least SEBI has 80%. But, you need to look at unaudited population, which goes as part of consolidation, because many times we have seen, I think, what's happening, from that standpoint also. So I think that's important consideration in group audits. So I think by and large, these are the things which I want to speak about. Obviously, I think you don't have much time, from that perspective. So as I said, I think the focus you should always have is that you've got to be skeptical. You got to make sound judgment. There's no other way. There's no other thing, in making the sound judgment, but you need to have all the rationale in place. So I think I'm sure I think 5:35. So I think obviously I want to make slightly more interactive if you have any questions for me. So over to you.
Sir, I have certain questions.
Please go ahead.
Yeah, for one question is, what are the common observations in a PCOB inspection that you have noted?
See, PCOB inspection, I think the common observation I'll tell you, I think the maximum observation in PCOB inspection is on revenue recognition. Top number one, if you look at it, revenue recognition is the top. It always comes as top. Second common observation is especially, I think, review controls. I think PCOB expects certain rigor in the review controls. How you test the review controls, because I think obviously they look at in terms of what's the review control and how you perform, who performs as an auditor, how you test the review control, because it's not very easy to test that, right? Sign off is not a review control, it's one of the evidences. So in IFC, I think I've seen maximum of the review control point coming through. Third is a general entry testing. I think it's top area, I think, which I see every year, issues coming up in that area. And next is financial instrument, especially on valuations. Fifth is actually impairment of intangibles. It's a famous once again. Sixth is the disclosures, right?
Yeah.
And the seventh is independence. I think these are the common, areas which I see year after year. But top one is revenue.
The other question that I had was, what are the most common mistakes that are pointed by EQCR, and what can we drive home from it?
I think EQCR in the planning I see always top 3 or 4. One I always see is independence, not having proper process, not having proper system, or having proper process system not following up properly. So independence conflicts is one area. Number 2 area is that assessment of materiality not in the right way. Either setting too low materiality and you do over auditing, or setting very high materiality and doing less audit. This is a very, very common pitfall which I've seen in this regulatory review. So materiality is one area, independence, risk assessment. The regulators are saying that as an auditor, you are defaulting on only 2 risks. You are taking revenue as risk. You are taking management of risk. I think the rest of the other risk you don't file. You don't have at all in the files. A study was done. 90% of the file only had these 2 risks. So they were asking that, do you think there's no other risk? For example, contingency in commitment, related party, investment, intangible. So risk assessment is other area which is highly kind of criticized by regulators from that perspective. So materiality, independence, and this risk assessment. In consolidation, I think many a times is a coverage. How comfortable you are on coverage as a group auditor, and how much component has done, what sort of communication you had with the component auditors, how you're kind of comfortable on that, all of those things. Expertise are only increasing there in that area. So group audit I see mostly in that, and going concern assessment has now become a flavor actually. More and more I see files failing on going concern assessment, not enough done or not been properly disclosed or reports not been qualified. Apart from that, I think revenue testing is always the area of concern because it's a risk area. You always have that as a risk. So some of these are common pitfall which come through the EQR testing.
And how much weightage do you think that planning and risk assessments hold when it comes to maintaining the audit quality?
See, at a benchmark, you should spend about 40% of your time on planning. Even if you do at 50, I have no problem. Here, what is happening is that you spend 30% of the planning. See, planning has to be done by a senior management team. The partner should lead that planning from the front, coach the team. That is a very important, just to ensure that how the partner looks at the engagement, risk assessment, materiality, fraud risk, controls on audit strategy. Of course, in case of group, I think the coverage. So in my mind, getting the planning 40% is a benchmark. You've got to spend adequate time, because once you get your strategy right, it's more of execution. If you get your strategy wrong, then I think you'll go back and forth.
One question more, sir, I have. If you could just summarize and define audit quality in one sentence, what would it be?
For me, audit quality in one sentence is that how do I demonstrate I have followed accounting standard, I have ensured compliance with accounting standard, I have ensured compliance with auditing standard, I have ensured compliance with the laws and regulation which is applicable to financial statement through my testing and through my control testing and substantive testing. If you are able to demonstrate, you are there. Because at the end of the day, you don't do anything in audit apart from these three things. It's not a rocket science. I just do three things: compliance accounting standard, compliance auditing standards, compliance with law and regulation. That's all in one sentence.
All right. That's it, sir. That's all the questions that I have. I'll invite Anil, sir, for the vote of thanks.
I hope anyone has any queries there, Neha ji.
Sorry?
Any other question, Neha ji?
No, sir. That's it.
Acha, sir, I am having a question recent. So if you permit, can I ask that question, sir?
Please go ahead. Please go ahead.
Sir, enhancing audit quality also comes with increase in the cost in tune with it. With every entity cutting down on cost, more specific audit fees, etc., it is a tightrope walking for auditors to balance audit quality and resultant costs. How
Yeah.
to go about the same?
See, I think this is where I think as a profession we need to come forward. If you look at, I'll just give the flavor in terms of what's happening in the developed market. In the developed market, the regulators have developed benchmark, especially I'll talk about SEC. If depend upon the size and the audit quality, I think the audit fees they compare themselves, forget about auditors and audit committee.
Yes, yes.
Compare it and they send a note to the audit committee and the auditors that this fee is not reasonable. Can you demonstrate? They're asking this question. It will come in India as well. It's just because SEBI is going to ask this question. I'm happy for that, because end of the day, when you're casting so much of responsibility on the auditors, no business can run without profit. We need to all understand that. So I think here in Indian context, we need to educate. First, I think we need to be united, first of all of us. Look, I think the expectation from auditors increased, number one. It's gone up significantly. Then obviously we need to pay for it. I think that awareness has to come through. I think NAFRA also is doing something on benchmarking. Hopefully, I think they'll take it next level. Now, I think the regulator will start questioning the audit committee chair that how do you demonstrate this audit quality with this fee? And to the auditors also. I think and also I think the most important energy is that we need to understand. I think reducing the fraud is not the only response of the auditors. Corporate governance cannot be responsive of the only auditors, unfortunately. It is a responsibility of all stakeholders, independent directors, promoters, Management, auditors, regulators, society at large, all have to play a role, right? As an auditor, I don't sit in the board of directors meeting. If somebody tells me that, the board is, the board is fine, you are only responsible, I find it very unreasonable. That means independent directors sit in the board of directors and they don't go through any of the strategies. I think we are going there. I'm happy that I think we are making those steps, but we need to take step very fast because our capital market has changed now completely. What worries me is not
Yes.
sometime is that, Anilji, is that the people who are investing in capital markets are auto drivers, housewives, through all SIPs. And today, if you look at the domestic institutional investor, has gone up from 6% to 20%. Tomorrow, if there's any corporate blunder, it's going to impact the common man in India badly. And then we lose the capital market confidence. वो मुझे बहुत डर लगता है. We all have to work together. I completely understand that audit fees is one of the key critical matter. We got to really deliberate anticipation, and we need to set our bars very high. That look, I think this is the cost it requires to do a quality audit.
Yes. Sir, in continuation to this, while applying the SA 220, what general guidelines you suggest to the auditor to follow for this while auditing the financial statements, how to follow SA 220 relating to the audit quality?
See, basically, I also perform a load of audit quality. I think, see, one, you got to be independent as a quality review partner. While engagement team, engagement partner, they kind of do their activity because they're more close to business. And obviously, they understand a lot better. I think the most important thing in 220 is that the quality review partner should be really independent. Number one. Number two, the quality review partner should understand the client business thoroughly. If you are a bank, kind of a quality review partner or you're whatever it may be, I think the business understanding is very, very important. The third thing, quality review partner should know that the what judgment the engagement team has done. But always focus to in quality reviews that tell me, I think, what judgment you have made in this audit. It could be in terms of materiality, it could be in terms of risk assessment, it could be in terms of complex accounting matters, complex auditing matters. So I want to know the judgment and how they made those judgments. Because routine things are fine. With judgment, understanding the business, judgment, independence, and asking critical questions before they release a financial statement and be comfortable on those judgments, especially I think accounting estimates. An Indian context, I think more so on related party transactions. The focus is always on related party transaction. Okay, tell me which is not normal, kind of in the normal course of business, what is not in normal course of business. How do you identify that? So some of these are very important. And my question to the engagement team is also on the performances. I think by benchmarking, if your company is doing and your company is doing why, tell me why it's doing so. So I think that independent and a couple of understanding and this whole thing which I spoke about, and challenging I think the engagement team on professional skepticism whether they applied or not. And many times what happen, engagement teams are so they just become okay fine एक client को मैं जानता हूँ 10 साल से मैं audit sorry to say in Hindi I'm auditing for last 10 years fraud नहीं होगा client में I think one thing we should take out from our mind that there's no fraud, there's nothing called everything will have fraud today. We have to start with that definition now. So I think some of these critical aspect of the quality review partners really plays a very important role in it.
Sir, are there any guidelines or regulations, if you suggest it is under the SEBI or RBI, which are strictly to be followed by auditors wherever applicable? And if there is any violation or such discovered, so later, what are the consequences for the same?
See, I think let me talk about one by one. I think if you look at RBI, I've been doing large banks and NBFCs. I think their entire focus on three things actually. One is obviously, I think, their ECL. How comfortable you are on ECL, what work you have done, how you challenge management, and how you're comfortable on that ECL provision, what the client has made. I think that's where their entire number one. Number second focus is the regulatory ratios, whether it's a capital adequacy ratio or liquidity coverage ratio or this liquidity mismatch. Their focus is on that. The third focus, obviously, on the risk assessment. I think how comfortable you as an auditor that you understand the risk. So I've been seeing it in RBI is moving in that direction: risk assessment, governance plus ECL, and also I think investment. If investments are more on very aggressive treasury, you have so obviously a lot more questions on that and off balance sheet item. I think these are the element which comes through, and you have a lot of muscle direction. So my request is that always focus in this area, 5 areas which I talked about: the ECL, off balance sheet items, active treasury if you have, then risk management policies, and overall controls. I think that's I think same similar thing goes with IRDA also. SEBI, I think obviously of late, I think the SEBI's focus is one, I think, obviously on the related party transactions. Even NAFTA focus also, if you see, I think off late is all on related party transaction, because unfortunately, I have to say that many frauds have been orchestrated because of related party transaction. So their focus in that area, understand the related party, challenge it up. Are you comfortable? If you're comfortable, fine. If you're not comfortable, then how you're really reflecting in your audit report. I think that's where I think their mindset is more and more into that. And second aspect is, I think, NAFRA is more concentrated on the internal control. How do you really test the internal control? How you kind of assess? See, Anilji, I think most of the good thing is that ICAI has a lot of checklists, very robust checklists. I think thanks to ICAI, I think they've done a great job over the last so many years. I think one has to really because everything you have guidance note, and every institute comes forward all the time. We as a member need to just be sure. One, I think the partners take a look at it, the manager take a look at it, and we push our teams also to take a look at it, because many beautiful checklists have been developed. If they follow the checklist, 90% of the problem is through. The 10% you can look at it. And most important thing, I think the biggest challenge we have as a profession is that we have everything in our mind, we don't document properly in the files. I think today they're looking at the documentation. Okay, fine, we understand that you've taken a judgment on 31st March and I'm reviewing that financial statement after 2 years. But tell me, I think, how did you come to the judgment? And we're failing to demonstrate the file and we're getting into trouble there.
Yes.
And people also, I think, last point, just say, many people tell me that quality, I think documentation is a boring thing. Remember, I think documentation drives the audit quality. I still, as a partner, sometime when I start writing, I think that, okay, boss, I think I need to do this also. So please remember, audit documentation only enhance audit quality. It'll make you to think twice, because what happens when you start writing down in the paper, you'll realize that you have missed one particular procedure, you have missed something, so those will come to your attention. So give importance to the audit documentation, drives audit quality.
So now we come to an end, sir. Thank you so much on behalf of AASB of ICAI for your expert knowledge as well as expertise you have shared with all our members, and continuously you have spoken 2 hours at a stretch. So thank you so much on behalf of AASB of ICAI for sparing your valuable time and enlighten all our members, sir. Thank you so much, sir. I also thank Neha Madam for wonderfully coordinating our today's webinar. On behalf of AASB, I extend my heartiest thanks to you, Neha Madam, and Shri Abdul Majid ji for your kind presence. I also extend my heartiest thanks towards all the participants of the today's webinar. Thank you so much. Namaste.
Thank you so much, sir.
Thank you. Namaste.
Take a leave. Thank you so much. Namaste. Thank you.
Thank you.